Good morning. As the U.S. markets are open and running this Wednesday, November 12th, Bitfarms, trading on the NASDAQ under ticker BITF, is seeing some significant pressure. The stock is currently trading live at $3.37 per share, which is a drop of 8.91% on the day. Now, the immediate expectation, the gut reaction for anyone watching this on their Robinhood app or Fidelity mobile app is to immediately check the price of Bitcoin. The common belief is that these mining stocks are nothing more than a leveraged bet on the underlying asset. If BITF is down almost 9%, Bitcoin must have fallen out of bed, crashing below the $100,000 level. But here is the critical reality that is catching so many off guard. As of this moment, Bitcoin is trading strong, up 1.73% and holding firm at $104,880. This is a massive, alarming divergence. This isn't a case of the proxy following the asset. This is a signal that the market is aggressively repricing Bitfarms itself based on its own specific fundamentals, and it is happening just one day before the company is scheduled to report its third quarter 2025 financial results. This 9% drop is not a Bitcoin story, it is a Bitfarms story. For most investors, especially those doing self-investing or just starting an online investment program, the mining sector is treated as a monolith. You buy a miner, you get exposure to Bitcoin. This is the simple narrative. You see NVIDIA stock as a pick-and-shovel play on AI. You see BITF as a pick-and-shovel play on crypto. But this view is dangerously simplistic. The reality of the mining business, especially in the high-stakes post-halving environment of late 2025, is that it is a brutal, industrial-scale war of operational efficiency. It's a race for two things: the lowest cost of power and the highest rate of hash. Today's sell-off in the face of a strong Bitcoin is the market screaming that it has serious doubts about Bitfarms' position in that race. The expectation is that a $104,000 Bitcoin price means all miners are printing. The reality is that the global network difficulty is soaring, and if your operational costs aren't rock bottom, your margins get squeezed, even at this price. This is what separates a high-quality industrial operator from a simple leveraged gamble. Let's dig into the pressure points, because this move is rooted in fundamental analysis, not just technical trading. The entire sector is in a state of flux. Bitfarms' competitors are not sitting still. We just saw massive, multi-billion-dollar cloud service agreements from rivals IREN and Cipher Mining with tech giants, signaling a strategic pivot to high-performance computing and AI. This has fundamentally shifted the valuation model. The market is now rewarding miners who can leverage their massive grid-connected power infrastructure for more than just mining. Investors are looking at their Fidelity brokerage accounts and asking, is my miner just a miner, or is it a future AI data center operator? Bitfarms has in fact been talking about its own HPC AI strategy for months, particularly around its newly acquired U.S. sites and a $300 million debt facility from Macquarie. But the expectation that this pivot would be simple is colliding with the reality of execution. The market is now demanding proof, not just press releases. This is why tomorrow's earnings call is so critical. Management must provide concrete updates on this HPC AI diversification. A failure to do so could confirm the market's fear that they are being left behind by competitors who are already signing nine-figure deals. This brings us to their core mining operations, which are the source of today's anxiety. While Bitfarms has grown its hash rate significantly, reaching 19.5 exahash per second earlier this year, the focus has shifted entirely to cost. In their Q1 2025 results, the company reported a gross mining margin of 43%, which was a sharp decrease from 63% in the same quarter the prior year. This shows the margin compression is real. Their Q4 2024 report showed an average direct cost of production per BTC at $40,800. While that sounds great when Bitcoin is at $104,000, that cost figure is moving. Network difficulty is climbing, and energy costs are a constant threat. Furthermore, the company has been transforming its portfolio, acquiring Stronghold Digital Mining in the U.S. while strategically selling its 200-megawatt Yguazu site in Paraguay. This was a massive rebalancing act, designed to lower their cost of power and focus on the U.S. market. But these are complex, capital-intensive moves. This isn't as simple as buying Apple stock and waiting. This is an investment in a heavy industrial build-out. Investors on investing sites and those using SoFi Invest are now worried that the capital expenditures for this U.S. build-out are rising, and the timeline to get these new, efficient sites online is dragging. And what about the balance sheet? This is a core part of the story for any miner. How do they manage their treasury? Bitfarms has historically been more willing to sell its mined Bitcoin to fund operations and growth. As of their last update, their treasury stood at 1,166 BTC. This is a stark contrast to competitors who hold on for dear life, almost everything they mine. This is a strategic choice. Selling BTC, especially at high prices, funds operations without diluting shareholders via at-the-market offerings or taking on more debt, but it also means they capture less of the upside from the asset itself. This is a trade-off, and right now the market seems to be penalizing this sell-to-operate model, perhaps fearing that the company's operational cash flow isn't strong enough on its own. This is a level of nuance that a simple SoFi robo-advisor or a Schwab Intelligent Portfolios algorithm might miss, as they may just classify all miners in the same high-risk bucket. This is where active online investing and digging into the financial statements, like you would in a Fidelity IRA or an individual brokerage account, becomes essential. For those new to the company, Bitfarms is a global Bitcoin mining company founded in 2017. They develop, own, and operate vertically integrated data centers in Canada, the United States, and Argentina. Their entire business is to build the infrastructure, plug in specialized computers, ASICs, and use massive amounts of electricity to secure the Bitcoin network, earning new Bitcoin as a reward. They have long prided themselves on using a high percentage of low-cost, environmentally friendly hydropower. But as we've seen, this simple and clean business model is now facing the complex realities of margin compression, intense competition, and a strategic pivot into the AI computing space that is proving far more difficult than many anticipated. This isn't a stock for Fidelity mutual funds. It is a pure-play, high-beta investment on a management team's ability to execute in a cutthroat sector. Looking ahead to tomorrow's Q3 earnings call, the stakes could not be higher. That 9% drop today is the market's way of saying, "Show me." Management needs to deliver on three fronts. First, a crystal-clear update on their operational efficiency. What is their all-in cost to mine one Bitcoin today, and where is that number going? Second, they must provide a tangible, detailed update on the HPC AI strategy. Have they signed any customers? Are the U.S. sites ready? And third, what is the balance sheet and liquidity situation? After a $500 million convertible senior notes offering in October, the market needs to understand their complete capital structure. This is the kind of investment help that only a management team can provide. This is the crucial question. Do you believe Bitfarms is being unfairly punished and is a value play compared to its peers, or is this 9% drop a warning sign that its competitors are leaving it behind in the pivot to AI? Let me know your stance in the comments. This is a stock that requires active monitoring. Traders on the Interactive Brokers trading platform are likely watching the order books and options activity very closely, anticipating extreme volatility around tomorrow's call. It's a classic case for those using the SoFi trading platform or Robinhood stock trading who thrive on binary events. But for long-term investors, this is a moment of truth. In summary, that jarring 9% drop to $3.37 is the entire story. The expectation that a $104,000 Bitcoin price lifts all mining boats is being shattered. The reality is that Bitfarms is being individually judged on its operational margins, its debt load, and its perceived slowness in the all-important race to diversify into AI. This sell-off is the market pricing in the risk that tomorrow's earnings will confirm these fears. While this isn't a safe haven stock like Tesla stock, which has its own volatility, or a blue chip, this is a company at a crossroads. The expectation was a simple BTC proxy. The reality is a complex industrial operator under immense competitive pressure, and the market is finally waking up to that fact. Disclaimer: this content is for informational purposes only. It's not financial advice, so don't make any decisions without doing your own research or consulting a professional. If you found this helpful, don't forget to like, comment, and share. Stay smart with your money.